Welcome to our first quarterly update of 2021. I'm Rob, and we're going to talk about all the macro topics we can, but also dive into some of the strategies as well. And 2020 had lots of things to talk about, and 2021 has continued that trend. There's no shortage of things to discuss. We had volatility in equities driven by interest rates. We had infrastructure bill talks. No shortage of things, as I said, to really get into, and we'll dive into all of that. But I have here with me Daniel Robichaud, who is the portfolio manager for international and US. So Dan, why don't you walk us through some of that stuff?
Hey Rob, yeah, so clearly a lot of things to talk about. I'd say in general, though, the themes were the same than what we've seen probably last quarter, but the focus shifted a bit more to the rollout of the vaccine. So a lot of investors were looking at the progress. If we look at the US or even the UK as example, the vaccine rollout is going fairly well, and we're seeing a relaxation of the pandemic-related restrictions. So investors really cheered that, but other factors were probably, again, monetary stimulus, a lot of attention to what central bankers would be saying, and what we heard is same message: we're going to keep the short-term interest rate low, and again, that keeps investors happy. Finally, a lot of headlines on fiscal stimulus. We've seen large checks in the US being sent to consumers. There's a lot of discussion around the infrastructure bill, or a lot of money that could go that direction. So all of that together kept optimists around the economic recovery we're going to get as we're heading out of this pandemic, and led to strong performance for global equities.
Yeah, and a lot of those things that you're mentioning, they all have to do with that demand side of the equation, of the demand-supply equation. And so when we think about what that might do to prices and to inflation, we have to think about the supply side as well. And throughout this pandemic, we've had supply chain issues in several industries. Lumber comes to mind, but also like trying to order anything off IKEA can take quite a bit of time these days. And so we've seen a restriction because things aren't moving as smoothly as maybe they would have in the past because of certain restrictions between geographies. But then you have this potential large increase in demand from the stimulus checks, as you mentioned, and the infrastructure bill, and pent-up demand from people being at home for so long. And so that fear of inflation, of that imbalance, has really driven up interest rates. As inflation expectations continue to rise, people are expecting, or investors are expecting, their money, the value of their money to erode. So they want more compensation to hold some of these securities, which means they want higher return or higher yields. And so that pushes down the prices of bonds, pushes up interest rates. And that's exactly what we saw this past quarter. We saw some pretty large moves, actually. Like the 5-year rate in Canada, for example, more than doubled. We had over almost 90 basis points increase in the 10-year. And so these are pretty significant moves, reversals of what we saw at the beginning of the pandemic when interest rates really took a large dive. And that really reverberated throughout markets, particularly equity markets. Why don't you walk us through that as well?
Mm-hmm. Like you said, we've seen a big move in interest rate. And while equity markets were strong, this really led some different factors performing better than others. So really the highlight this quarter were cyclicals and value. When we think of cyclicals, it's the sectors that's going to benefit the most when the economy is stronger, and now as we're getting more optimistic around the recovery, that sector did well. And value, I'd say it's names that we'll see as shorter duration cash flow, so their valuation is less impacted by the higher interest rate. When we look at cyclicals, I think two sectors really come out. We're looking at energy and the base metals, two sectors again are really exposed to the economy, and as the optimism grew for investors, we've seen the commodity go up much higher, and that sector performed very well. The other highlight of this quarter is financials with banks. Here, I think they benefit from kind of those two factors of value, from the short duration cash flow to also cyclicals, as they a lot more exposed to the economy. When things going well, it's good for banks. And the final aspect to banks is the yields got steeper, and their business model is often making money on the spread of what they're lending and what they're borrowing at. So that mismatch, that mismatch really is good for them and should generate more earnings. So that's a sector that really performed well during this quarter. Looking on a geography basis, really the winner here is Canada. Canada is heavily exposed to energy, heavily exposed to banks. Both together, it's almost 40% of the index. So Canada was the winner this quarter. It was up high single digits. The next one is really the US. Generally, the sectorial positioning is not favorable for them because you've got heavy exposure to technology, which would fall into that growth bucket and higher duration cash flow.
Yeah, we're expecting their cash flows far in the future. Higher interest rates mean you got to discount that back at a higher rate. So yeah, it creates a valuation headwind.
Mm-hmm. So even if they have not the most favorable sectorial positioning, given the trend of the strong rebound we're seeing and the success or the good progress we've seen on the vaccine rollout, U.S. Equities still performed quite well and was up kind of a mid-single digit through the quarter. The loser this quarter was really international equities. UK rollouts is going fairly well, but when you look across the rest of Europe, the vaccine rollout is slow, restrictions remains high. I think there's a lot of concern about how robust the economic recovery is going to be there, and that got reflected in the performance this quarter where they were up just low single digit.
Yeah, I think most of what you said translates directly to the fixed income markets too, where corporate credit continue to tighten in as the economy, as the people view the economy as more favorable going forward, and demand, as we've talked about throughout this conversation, is looking like it's going to be strong. And it doesn't quite work out necessarily the exact same way on a sector by sector basis, but really we've seen in general that reach for yield continue, where corporate credit spreads continue to tighten in. That's mostly driven by that spread between the government bond and the corporate yield. That as the government bonds have increased in yield, the corporate credit hasn't necessarily increased to the same extent, so that's kind of shrunk that spread in between. But in general, that's kind of, I think, a good way to think about how it's worked for corporate credit as well. Thinking about how our fixed income portfolios are really positioned, we took this opportunity as duration. If we were shorter duration than the index, and given that was a good positioning for us during the quarter, the actual longer dated maturity started to look a little more attractive. So we actually started to extend our duration a little bit closer to where the benchmark is, and we've been doing that for a few quarters now, and we continue that this quarter. And we also decided to get a little bit more exposure to corporate credit as well. And what we do with corporate credit in our funds in particular, and we continue to do that this quarter, is really focus on a shorter maturity schedule, but also higher quality companies. We're looking at things like grocers a lot, and we're looking at midstream versus producers. We're really making sure that we're maintaining a more conservative bent, but that enables us to pick up some yield. And so that's kind of been our positioning in the portfolio there. And if you think about what we're looking at going forward, we're really keeping our eye on central banks. You mentioned that at the top, where you've seen a lot of what's going to happen with quantitative easing, and our central bank's going to move interest rates sooner than expected or not. That's going to be some of the bigger drivers for the fixed income side, and we'll be keeping a close eye on all of that. And why don't you walk us through what's going on with the equity portfolios in terms of positioning and how it relates to versus the benchmark and that kind of stuff.
So when we look at just this quarter in terms of performance, obviously it's always tough to generalize around the mandate, and one of the reasons around that is we're really bottom-up focused. So a lot of the positioning is really driven by where we see values in the names we like. So it's tough to generalize, but overall still say we've done fairly well. And one of the main reasons is if you look at our funds, we've been struggling over the last year or more of finding value in the growth stocks. So if you look at names in Canada like Shopify, or in the US like Amazon, we're not there. They're big index weight, and we just struggle with the risk reward of those businesses, even if we really appreciate their prospects in the future. It's more a valuation issue. So we've benefited from that rotation out of that sector. That helped us. The offset to this is if the sectors I mentioned previously, if you look at energy, so in the energy producers or even the banks, those are business that we normally see as lower quality. we perceive them as having a lower moat behind their business, and we had a lower exposure than the benchmark. So that kind of partly offset some of the gain from the rotation there, but still overall we're happy. We had good relative performance across all our fundamental mandates there. Going forward, if we think of the positioning of the fund, again, it's really driven by the risk reward and our bottom up focus, but in most cases, I'd say we have more a defensive tilt, which is a function of where we see the most value. So one example is if you look at the dollar stores in Canada with Dollarama, or in the US with Dollar General and Dollar Tree, those are businesses that we think gonna continue to thrive in this recovery here, but the valuation remains discounted. So we see very favorable risk reward and have a high exposure there. Another example is of something we like is Deregulated Utilities. Valuation remains quite reasonable. They're defensive businesses, and one of the nice attributes here is there's a lot of talk about higher corporate tax in the US to fund all the spending we had through this pandemic, and those businesses are protected given they earn a rate of return after tax, so they're, no matter where the tax rate goes, they're going to make the same cash flow. Right. So those are two examples of things where, or place where we see value, and we continue to favor those businesses. But the plan is keep a balanced approach. We keep looking at growth year option also, but we remain disciplined. That's the key.
Yeah, I think that's a great place to kind of end it. I mean, all of our mandates, fixed income to equities, I mean, we're taking a bottom-up approach. We're thinking about things from a balanced perspective, and we really want to get paid for the risk we're taking on. Well, thanks for tuning in for our market update, and we'll see you next quarter.